I think a month ago.
Hello, this is Joey from Phillip Nova. I will be facilitate the webinar today. Thanks for everyone's tuning on time. Let's give some more time for those people registering to tune in later. The webinar will start at 7:03 sharp. Okay, thanks everyone for joining the webinar. For those who tuned in the last time, apologies that we faced a technical issue the last time. So thank you for making the time for today's session. For today's session, you are going to hear about the warrants industry veteran to get an overview about warrants trading, including why trade warrants, real-life examples of the benefits of trading warrants, and some risk management strategies should you be keen in starting to trade warrants. And then there will be some outlines or the current key talking points that will be covered today. First is the basic of the warrant, and then why trade warrants, and then some also the real life examples of how warrants have performed and how to select a warrant to trade. And also Jamie will be covering the risk management when trading warrants as well. And then also some free resources you can access to support your trading. Before we kick start our session, just wanted to do a quick introduction of Phillip Nova's ongoing promotion. Actually, this year is Phillip Nova's 40th anniversary, and then we have plenty of the exciting promotions to celebrate this milestone with you. If you are not a Phillip Nova client yet, open an account with us in October. You can get a 250 Decathlon voucher. For more information, you can scan the QR code to find out more. And if you are a Phillip Nova client already, here is an ongoing promotion for you as well. You can win an Apple Watch Ultra and more if you trade with us. For more information, you can also scan the QR code to see. And also coming back to our session today, today's webinar topic is getting started on trading warrants. Let me just do a brief introduction of our speaker today first before we kickstart. We have our speaker, Jamie Chung, head of Singapore Warrants, Macquarie Commodities, and Global Markets. Jamie has been educating investors on Singapore warrants market for more than 15 years now. With her unique blend of warrant market making and sales responsibilities, she is equipped to provide attendees with information about warrants in order to better understand the product as well as make market insights and also address various warrants queries. And before I pass the time to Jamie, this is the last activities for the session only for you. You also have a chance to get the $10 Grab voucher. How? Very simple. In the Q&A session later, just ask the questions to Jamie, and then Jamie will choose the 3 questions, and then you will, the 3 of the attendees will get the vouchers today. We will notify you whether you are the winners tomorrow. So stay tuned in, and then let me pass the time to Jamie.
Hi. Thanks, guys, for attending. I wish I had an Apple Watch to give away, you know, for trading warrants, but unfortunately, we do only have a $10 Grab voucher. But more importantly, with the content that I share today and the education that I'm providing, hopefully you do make, you know, money, more than enough money to get yourself an Apple Watch and more, with potential returns that you might get by trading warrants. So thanks for joining once again. My name is Jamie, and I head up the Singapore Warrants team for Macquarie. And today, I think before we even talk about what warrants are, I would like to, I guess, whet your appetite on this product by talking about why you should even be considering it, or why you should be getting interested in knowing this product. Now, there are essentially 2 types of warrants, you know, and obviously I've simplified this because I want you to first think about why you even want to consider this product. But essentially, there are 2 types of warrants, a call and a put warrant. Now, a call warrant generally tracks the value of an underlying to head higher and vice versa. And so this is therefore suited for someone who is bullish on underlying, who thinks that it's going to go up in the short term, because then the call warrant price would, you know, track the underlying higher. However, if you were bearish in the short term, and these days, you know, with the news in the market, there are many reasons to feel some level of fear in the short term. I mean, just upcoming, we do have, you know, the US talks of the US government shutdown, and obviously dismal news that continues to come on the China front, yields topping 5%, etc., all lending, you know, short-term pressure to global indices, right, as well as stocks. And if you're one of those worried, then maybe you would want to consider a put warrant because it goes up in value, in price, when the underlying it tracks goes down. And you can see from the chart from the slides here, and this is what happens when you purchase a put. Structured warrants are listed on the SGX, on the exchange, and how you can identify them is largely via the 4-digit alphanumeric warrant code that they go by. In the case of this first warrant here, what do you think this warrant code is? Anyone wants to type that out in the Q&A? No? Okay, then I'll tell you very quickly. The 4-digit unique code for the first warrant here will be ZP4W. Okay, and the second warrant at the bottom row will be FPKW. So on the exchange, you can identify them that way. But if you look at the full name of it, generally warrants, they're named after the underlying that they track. So in the first example at the top, this is a warrant that tracks the Hang Seng. Now, and the bottom row, this is a warrant that trades DBS shares. Now, you will notice in the first example that it has the digits of 19,400, which is essentially the strike price of the warrant, whilst the DBS warrant does not have the strike. Why is that? That's because for index warrants, generally, there are many of them expiring with the same expiry date. And so for easy identification of which warrant this is by strike, the strike is often included for index warrants, but not included for stock warrants, which tend to expire at different dates. Okay, so moving on from the first example of the Hang Seng warrant, you've got the underlying, you've got the strike of 19,400. This is then followed by the issuer code. In this case, Macquarie Bank is the only issuer in Singapore. So the only code I can tell you about is MB. Okay, this is then followed by the, I think, three most important things that you should look out for in a warrant and in identifying it. In this case, this will be ECW, representing European style call warrant. And why is this important? That's because if you're bearish, you will not be purchasing an ECW, but rather you'll be looking out for an EPW, which represents a European style put warrant. And what does European style mean? It means that essentially this warrant is one which can only be exercised at the expiry, whereas American style, warrants or options, they are exercised anytime. But all structured warrants listed in Singapore are all European style, okay? So they will all have an E ahead of whether it's called put warrant. Now this is then followed by a series of numbers, 6 digits often, and it is essentially the expiry code of the warrant in a year, month, date format. So let's see, fastest fingers first. What is the expiry date of the second warrant, the DBS warrant? Can anyone type that out for me in the next 3 seconds? No? 3, 2, 1, okay. Another chance to win the Grab voucher, okay? So you need to respond quickly if you want to win that. Now, having moved on, having understood the naming convention for warrants, if there are no questions, I'll move on to why you will consider a warrant. There are many reasons, but I have identified the 4 top reasons as to why investors generally want to consider a warrant. Or if you have not traded it before, the reason you will want to consider a warrant is really because it offers you different levels of gearing. Now, what is gearing? Gearing is the ability for this product to move and magnify its moves relative to the underlying that they track. And in the case of warrants, we do not have fixed levels of underlyings, and we have various levels suited for various risk profiles, and I'll show you very quickly examples of how gearing works via warrants. The second reason is, apart from offering gearing, it requires only a very small amount of investment outlay. So if you've got, your investment capital is now tied up, whether it's property or with, a portfolio of shares, but you still wanted to obtain the gearing, which, the shares do not probably provide you with, and you want to supplement your portfolio with gearing, you can then use only a small investment capital to buy warrants. And why is that? Because they generally cost only a few cents. Typically, most of our warrants cost anything between under 10 cents to about 15 cents. At the same time, it provides limited loss for the simple reason that the low investment capital is small, and therefore even if you were subject to the extreme scenario of losing your entire investment capital when you invest in warrants, it is still limited to just a small amount of capital that you have placed up front, a small absolute price that a warrant costs, and that is really the maximum that you would have lost. And sometimes this could be less than the unrealized losses that one could be sitting on when they purchase a portfolio of shares. And finally, the fourth reason as to why you would probably want to consider a warrant is, apart from your ability to go long, okay, which is something that I think Singapore investors love doing, a lot do not know how to short the market. And warrants provide an ability and a chance, an opportunity for investors to go short on the market, to profit when share prices come off, or to hedge your portfolio of shares, in the short term when markets turn. And over here, I've had the example of how warrants work. In this case, this is the underlying of BYD shares listed in Hong Kong. And over a day, the shares gained 7.8%. But if you have bought into a BYD call warrant, in this case, this is the trending call warrant that we've got, FFAW, you needed to pay only 1 cent to buy this warrant, okay? This is a fraction of BYD shares, which means it will require only a small or low investment outlay. And in this case, it's gained 10 times, where the warrant price has gone up 80%. For the 7.8% gain in BYD shares. So it's gained from 1 cent to 1.8 cents, which is a 10 times gearing. So ladies and gentlemen, this is the effect of gearing, whereby the warrant has moved 10 times more than underlying. Okay, and I'll give you another example of using a put warrant to go short on the market after we've seen how we can go long via warrants in that case of BYD call warrants. Now, you can use the Hang Seng put warrant to go short on the market if you were of the view that the market, was going to get hammered below the 18,000 level amidst the negative news. So for example, on the 12th of October, after the Hang Seng index has really been trading within the 17,000 index range, when it finally popped above 18,000, some probably thought, okay, this is a chance to go short. I'm a bit nervous about the market being able to hold above the 18,000 level, and they wanted to go short. In that case, one option obviously is to short the futures directly. And if you had held on to it as the market headed to 17,000, and you thought, okay, that could be a near-term support, so I want to get out of this short position, I want to cover it. Well, you have made 7% over a 2-week period if you have shorted the Hang Seng futures. However, if you had entered into this short position via Hang Seng put warrant, in this case, our most popular put warrant over this period of time, Z7CW, you would have been able to short the market via this put warrant by buying the put warrant at 5 cents. Again, a fraction of the futures amount. Okay, and over this period when the market dropped 7%, this warrant went up 70%, and this is all real life, from 5 cents to 8.5 cents. Again, another example of the warrant going up 10 times more than underlying, in this case in the inverse direction, whereby it's clocked positive gains as the market fell. So this is the example of how one could use put warrants to hedge in the short term against their portfolio of shares, but also to merely profit from a falling market as and when you think that the news could be negative, or when markets have reached a short-term resistance technical level for it to turn downwards. Okay, I will provide you with more examples, because the 2 examples that we've gone through are over 1 day or over 2 weeks. We do have 1-month warrant trade examples of the top performing put warrants, and we'll highlight put warrants because, like I said, I think Singapore investors do not seem to utilize instruments to short the market enough. And over a 1-month period, if you were tracking JD shares or Meituan shares listed in Hong Kong, which went down anything between 10% to 22%, you would have made, via these trending put warrants that we have over these shares, anything between 4 times more than the underlying to around 4 to 5 times more than underlying. Okay, but of course, if you had bought the call warrant, and this is how gearing kicks in as well, and you had gotten your view wrong, obviously then the gearing works against you, and you'll find that the call warrants have gone down more, between 3 to 4 times relative to underlying as well. Now, looking locally, UOB shares, one of the banking laggards in the market over the past month, as it was down 2%, and UOB is going to report this week, so perhaps something you might want to look out for. But this put warrant did move up 14%, so that's close to 7 times more than underlying, as it fell 2%, whilst the call warrant did fall more than 20%. Okay, to illustrate further, some year-to-date examples. Now, warrants are generally for short-term views only. Why? Because first of all, they've got expiry dates, so they're not quite like the shares where you hold on to them forever, right? So, but really they operate in a way whereby it's just suited for short-term trading. Why? Because of holding costs, which I will cover slightly later. And so the longer you hold on to it, the more you have to pay for your holding costs. And this is why generally instruments like warrants are for short-term trading only. But can you still make money over a longer term period? Now let's look at some of the year-to-date warrant examples. The answer is yes, but what is required is for the underlying to move very strongly in your favor. How strongly? In this case, year-to-date, we have the examples of Sembcorp Industries and Keppel Corp, both top index performers on our STI, clocking about 41% gains as of 13th of October. And you see in this case, the warrants have gone up between 2 times to 3 times of the underlying, between 85% to 128%. And so examples of call warrants still able to magnify the gains over a year period despite the holding costs. But this is because underlying has moved so strongly in favor of the investor who has bought it, right? If you want to look at examples of how the put warrants have performed, unfortunately, the put warrants that we have over both underlyings were only listed on the 22nd of August. So we do not have a year-to-date warrant example for these 2 underlyings. Okay, hopefully, this has, like I said, whet your appetite a little bit so that I can now, it's dinner time, we can dive into the main course of this session, where we try to understand a little bit of how warrants work. Of course, if you have further questions, There could be follow-up sessions to go through them, but for now, let's go into how warrants work, you know, both in theory, but also in real life, and how could we, in fact, select a warrant to trade if we were interested. Now, recall I said that warrants are listed on SGX. So there isn't just one warrant for you to pick, and in fact, we have got warrants over 34 underlines, and we've got, you know, hundreds of warrants out there. But I would say, you know, some of the steps that we have advised investors to consider when they're selecting warrant is, first and foremost, always have a view on the underlying share price or the index futures that you're interested in. And why is that? Because essentially the warrants are a form of tool for you to magnify potential returns on the underlying that you have a view on. So it tracks underlying, and therefore you need to have the view on the underlying. You do not need to conduct any technical analysis, you know, or specific views on the warrants, you know, with regards to the entry and exit levels. Why? Because they track the underlying itself. So you need to do your technical analysis on the underlying. First of all, you need to decide, okay, when is a good time to enter the underlying? If this is a good time, this is the price, then you just look up the warrant and you can enter at its corresponding price. And we've got tools that tell you that, and I'll go into that later. And likewise, how do you exit in a warrant? You exit when the underlying hits its target price. Okay, and then the second step to consider is a holding period, and this is exceptionally, you know, important with warrants. Why? Because they're not like shares, whereby, you know, I think a lot of us are guilty of this, but if we get it wrong, we will tend to cold storage, you know, the share and throw away, you know, original intended investment period, and we hold it until it breaks even or makes gains. But you can't do that with warrants. Why? Because they've got expiry dates. You know, just like food, they don't last forever. So they're only good for the time that, you know, the life of the warrant. And the steps 3 and 4 are really, you know, considering the effective gearing levels. Why? Because I've just said one of the main reasons why one would consider warrants is for its gearing level, right? But there are different gearing levels, and obviously it can work against you. So someone selecting the warrant needs to decide, is this gearing level too much for me, or it's not enough? Okay, and you select your warrant accordingly. And finally, we want you to pick a warrant on tight spreads. Now, I'll give you examples of how we can go through each step, and starting with step 1. Now, in order for you to form a target entry and exit level, of course, you need to do your own homework. You need to decide. But if you were struggling with that, you know, this is why we team up with market experts from different, I would say, different organizations, different brokerages, some independent SGX Academy trainers, such as Beanie, who most recently talked about the Nikkei 225. We've also teamed up with experts like Daryl Guppy to talk about indices and specific stocks. I think within Phillip, we've got someone called Joey. You may or may not be familiar with him, but we team up with them to present these, you know, short-term market views to really inspire you on what could be moving in the short term. And of course, they do tend to provide entry and exit levels. Okay. And with that, I will want to show you an example of how you could use a tool once you've got your entry and exit levels to then decide and help you ascertain what your holding period can be. And this tool is known as the Warrant Selector tool. Now, we came up with this tool, I think about 2 years ago, really because we've interacted with attendees like yourself and have been given the feedback that you want us to help you with the warrant selection process. And so this tool, and I'll show you very quickly where this tool is available. Okay, this tool is available on, in my opinion, the best warrant website in the world, and this website is known as warrants.com.sg. I'll just share very quickly. Okay, this tool is found on warrants.com.sg, and this is the homepage here. This is me some years ago. To find the selector tool, you simply go to the warrant tools, drop down, go to the selector, okay, and you select your underlying. Assuming you had a view on, say, the Nikkei, right? Because I said we just talked about Nikkei. For specific levels, please dial, you know, either dial into some of her trainings, or you could watch our quick market talk view with her, or some of the YouTube videos she tends to do in partnership with SGX and ourselves to cover on different underlyings. But in the most recent one on Nikkei 225, she was bullish. So if you were to borrow her view, we'll then select a call warrant. And this shows you where the last price of the Nikkei 225 futures listed on SGX was. Let's assume that we have a view, and I know this because I've been attending her sessions. But in this case, assuming her short-term view was 32,800. Now that is a 5.6% return against where the current last price of the Nikkei is. In order to pick from the table of warrants available here over the Nikkei 225, that would be 5, we can then increase the number of weeks to see the simulated projected returns on these warrants, okay? In this case, I've just increased it to 2 weeks, and you see that in a week's time, if the Nikkei were to move 5.6% higher, the warrants will generate returns between 28.3% to 86.7%, right? And that is like a 5 to, I would say, 8 times, no, more than that, 5 to 12 time return versus the underlying, right? But if you increased it to 2 weeks, you find that the projected returns have dropped. You know, all of them have dropped, and they are in fact lower, okay? And why is that? Now, this is the effect of the holding costs of a warrant known as time decay taking place, whereby the longer you hold on to the warrant, the more holding costs you have to pay, the more the warrant will decay, and therefore it will make you lower returns versus holding it for a shorter period of time. However, you will note that even as you increase the number of weeks, okay, even with time decay setting in, you see that the warrants continue to generate geared returns versus the futures, and therefore it is still, you know, an instrument that will create potential returns more than the futures itself. How long should we hold on to these warrants for? You simply need to keep increasing this. In this case, by the 7th week, you see that the last 2 warrants here would have expired. So the maximum holding period on the last 2 warrants is, in fact, only 6 weeks. And therefore, if you had a holding period that was longer than 6 weeks, if you think the Nikkei was only going to hit, you know, above 32,800, 5.6% higher from here, next year, for example, it will take some time to break out of it. You will then keep increasing to see which of these 3 warrants will be the best pick. Now, in this case, by the 8th week, this second warrant here would have made you a loss of 3.3%, even if the futures had headed 5.6% higher. And therefore, this warrant with time decay that has fully eroded its the gearing provided by this warrant, you probably would not want to cancel this warrant. So you are essentially then left with just these 2 warrants to choose from, and you can keep increasing it until the geared returns on the warrant provide you no more gearing than the futures itself. So you can see by the 10th week, the first warrant and the third warrant continues to give you geared returns relative to the underlying, and you need only to choose between these 2 warrants, right? And you can take into perspective, of course, the amount of capital required in both. You know, some people prefer, you know, a lower price warrant. Some people don't mind that. And ultimately, there will be another tool for you to go into each of these warrants and find out what the approximate holding date, you know, that these warrants will continue to provide geared returns, and then you can take a pick from there. Okay, this is the warrant selector tool, and to go back to what we're talking about, this tool helps you determine the maximum holding period. So if you had the view, and if the market were to head towards your expected exit level, some of us like to hold on to, you know, the warrant just to see if the market could push a bit higher than 32,800 that we had projected. But this tool tells you the maximum holding period, you know, on this warrant. And so even if you wanted to hold beyond 10 weeks to see if the market could break above 32,800, this will tell you, okay, but what the maximum is. Okay, so going back to the specific date that you know, that you can hold onto the warrant for, you know, there is a tool known as the warrant calculator tool. Okay, so I'll just go back to the example of these 2 warrants. I said if you wanted to pick between these 2 warrants, how could you do so? Now, in order to do so, you can use a calculator tool, which is kind of similar but different. But to do so, you need to enter the code of the warrants. So you need to know the codes of the warrants. In this case, the calculator tool is found also in the warrant tools drop down. In this case, you go to the calculator here. And like I said, you need to know the exact code or the name of the warrant. So the first warrant that we're looking at based on the selector tool is IDBW. So I've entered IDBW here. Okay, and how this would work is it will require you to enter two things: the entry underlying level as well as the exit levels. So this is a little bit more sophisticated than a selector tool in that it tells you and projects for you the price of the warrant. If you wanted to enter only, let's say, if the market broke above 32,000, right? Okay, and obviously the market didn't hit 32,000 today, so assuming that the market went to 32,000 on 30th of October next week, okay? This will tell you that the warrant price would then be around 13.7. So you can expect to enter into warrant at 13.7 cents. Now, we talked about 32,800, right? So we can then enter it here. And we can then see how the warrant price would change, and I'll ascertain an approximate date of the holding period. Now, the selector tool told you by weeks, right? But now we want a specific date, and we can do so via the calculator tool. So we simply need to just increase the slider date, okay, to a further date, and you can see immediately by the 6th of December, okay, which is about 1.5 months from now, this will generate just a 4.4% return relative to the futures return of 2.5%. So it's beginning to lose its geared return relative to now where it moves, close to 10 times more, right? In December, it already would move less than 2 times more. So it's beginning to lose its gearing level. So if you're considering this warrant, you want to then take note that, you probably don't want to hold anything beyond, let's move the slider a bit more. Yeah, you don't want to hold this warrant longer than 8th of December. Why? Because on 8th of December, even if the futures underlying were to go up 2.5% higher to 32,800, this warrant will give you just a little bit more geared returns relative to underlying of 2.9%. Okay, and if you held on to it beyond this date, you will see that on the 12th of December, 4 days later, it in fact makes you no return. Again, why? Because time decay has set in and eroded off the gearing. Now, how does this compare to the other warrant that we wanted to select between? We were choosing between IDBW and VXJW, right? So in this case, we know that by the 12th of December, it will give you no return. Let's have a look at VXJW. I'll use this tab. Type in VXJW. Okay, and then we scroll down. Again, we put in the same parameters. We said we'll only enter at 32,000 where we have confirmation that it's truly broken above a key, resistance level and headed to the next level. And we said maybe this could happen next week on 30th of October. In this case, this warrant, its entry price will be around 30 cents or 30.5 cents. Now, the exit level will also likewise put into it 32,800, and we will increase the dead slider to see how it performs. Now, in this case, you see that this warrant has got less geared returns relative to the previous warrant of IDBW, in that it will move up just about 8 times more than underlying if this were to happen, sorry, not on the 24th, but if this were to happen next week on the 30th, it would move out less than 8 times more, 7 times more than the underlying. And let's see if we could hold on to this warrant for longer, we'll increase. Okay, by December, on 4th of December, it continues to move around 2 times and a bit more than the underlying. And on the 12th of December, it continues to give you geared returns. When will it stop giving you geared returns? At this point, it will be a better performing warrant compared to IDBW, which, remember, on the 12th of December would give you 0 returns, even if underlying were to move 2.5% higher. In this case, this one continues to give you 5.9% returns. Okay, and we can keep moving it until, you see, there you go, until it gives you less returns relative to underlying. In this case, on the 23rd of December, it's only going to give you 3%, and beyond that, it's gonna give you less return. So if you were considering this warrant, the maximum holding period would be around the 3rd week of December, on around 33rd of December, assuming all else factors were kept constant. And so if you had a view longer than the start of December, okay, if you had a view longer than 1.5 months, you would probably want to consider this warrant VXJW if you're bullish on the Nikkei 2 to 5 futures. But if you think that this could happen in the short term, then maybe this warrant could be better because it will generate you more geared returns, right, relative to this warrant. This warrant here, VXJW, has got lower gearing, lower risks attached to this warrant, but therefore it allows you to hold on to it for a longer period of time. So it's really up to you. Now, having said that, if your view on the underlying was higher, meaning you think that the index could go to 35,000, you see that even on the 12th of December, where the warrant previously I showed you that it will make no returns, this will now continue to make you 9 times return relative to underlying. Why is that? This is because the more the underlying moves in your favor, okay, the higher percentage gains you are targeting for the underlying, the more gearing will kick in to offset the time decay on the warrant. And so this gearing, okay, given a 9.4% return on the underlying, has more than offset the time decay, and it continues to make you geared returns all the way till, let's see, all the way till to the end of the warrant life, right, where it's the last trading day is on the 1st of March. It will continue to make you geared returns of basically about 3 times more than the underlying, as long as the market moved 9.4% higher relative to the previous example of 2.5% higher. This warrant also will make you geared returns if you held it to the end of its warrant life onto its last trading day of 1st of March, okay? But this will make you less geared returns of around 4 times the underlying. So it's really up to you, no better or worse warrant, but the point is this calculator tool helps you decide what is the ultimate warrant that you want to select, and ultimately the approximate date that you can expect to hold on to the warrant for. And I would suggest that investors should adhere to this quite strictly, because like I showed you as an example, if you held beyond the start of December for this warrant, the first warrant, you would then not make gains even if your view was correct and the underlying was to move 2.6% higher. Okay, so I've just quickly shown you some of the tools to help you determine, and that fulfills step 1 and 2 of the factors to consider when selecting a warrant. Now to move on to step 3, effective gearing, like I said, is the ability of the warrant to magnify potential returns. And different warrants, as you have seen via my examples, they offer different gearing levels, right? At the start of the seminar, I told you that some warrants offer 10 times, but in some of the examples that we've seen anything between 2 times to 5 times to 8 times. So different warrants have got different gearing levels. And how can you find that out? Well, you can go to our warrant website, once again, warrants.com.sg. Okay, and the other tool that tells you what, another tool, but this one is simple, I promise. It's called the warrant search tool. The other tool that tells you what the gearing is across warrants is the warrant search table, where we've got under the warrant parameters the effective gearing levels for all the warrants. And as you can see, they offer different gearing levels, okay, from anything between 3 to I think 11 times or 27 times, as you can see here. Okay, so to find out the effective gearing of each warrant, you need only to go to the warrant search page and find the gearing. Otherwise, you can click into the warrant, and there is a warrant terms tab, and you can straight away see the effective gearing level here, okay? And they differ for each warrant. Now, going back to how we can use the gearing level, apart from using it to ascertain where, to give us an approximation of how much the underlying will move. So gearing, in this case, for this warrant, this Simsky put X5RW. On the website, the gearing level is stated at 6.4. What this means is that as an indication for when the Simsky futures go down by 1%, this warrant should generally move out by 6% in the short term, okay? But how else could we use effective gearing? We could use it to determine the level of warrant investment that we will put into this warrant. So looking at the offer price of this warrant, this at the time of capturing the example, it costs about 7.3 cents. Now, if you had a portfolio of, say, banking shares mixed with some property shares, or maybe mixed with some C shares that you hold that are listed in the US, and you wanted to hedge this portfolio of shares in the short term because you're just worried about how the year-end earnings seasons, fourth quarter earnings seasons will shape up, and you're a bit worried about that. Or if you simply were going to go on a year-end holiday and you're wanting to insure or hedge against a potential short-term drop in the market, you could consider, index warrants such as Simski. And then depending on your total investment in the shares, let's assume that it was 100,000, okay? And you wanted to hedge this. How much should you invest into this put warrant? The answer is to use the effective gearing of the warrant, okay, and divide your warrant portfolio value amount. In this case, 100,000 divided by 6.4 will give you a $15,600 investment. To use that to determine how many units of this warrant you can buy, simply divide this investment amount by the cost of the warrant, in this case 7.3 cents, to derive around 214,000 of this warrant to purchase, and which you can enter on your Phillip Nova accounts, okay, once you have selected this warrant X5RW. Okay, so this is how you use effective gearing, and this is the third step in selecting a warrant. Now, the last step is always find a warrant on tight spreads. And in order to find out if the warrant was trading on tight spreads, we have got a tool known as the Live Matrix. Okay, this is a screen capture of it, but since we're on the website, I'll show you very quickly what the Live Matrix looks like and where it can be found. Okay, for you to locate it, again, warrant tools drop down, go to Live Matrix. Okay, in this case, again, just like the calculator, you need to know what the warrant code is. If you weren't sure, again, you can just select it by the drop down here. In this case, if we're keen to find out what this Hang Seng warrant was, we could go to the Live Matrix tab here, and it will show you what the warrant price is at this point in time as you are looking at it, or as close, because markets have closed, relative to the underlying futures bid and the offer. So I told you at the start of this selection process that you don't need to have a view on the warrant. You don't need to do a technical analysis on the warrant. Why? Because they track the underlying. In this case, you need to just have a view. And if you thought that you wanted to enter into the Hang Seng futures, it was worth a long at 17,060, you simply have to come to the Live Matrix and see where the warrant offer price would be. In this case, it tells you it would be 5.8 cents. And then you know that you could either enter to queue on your Phillip Nova platform for this warrant at 5.8 cents. And if you wanted to get out at a higher price and you were keen to find out what the warrant price would be, this Live Matrix tells you it. So for example, if you felt that at 17,260 you wanted to exit on the futures because you could be a day trader, you think 200 points from here is good enough for me. In this case, if you look at Live Matrix, it tells you that at 17,260 on the Hang Seng futures, the bid price of the warrant is 6.3 cents. So if you have gotten done on the warrant at 5.8 cents, you've bought it there, you know you can queue to exit at 6.3 cents. Okay, so that's one of the ways you can use the Live Matrix. But another way you can use the Live Matrix is to confirm that the warrant is trading on tight spreads. Now, generally, we will keep all warrants on tight spreads, and any security that's traded below 20 cents have got a minimum bid and offer spreads of 0.1 of a cent, so that's 0.001 of a dollar. So this warrant is on tight spreads, okay? I'll show you an example of a warrant that's not on tight spreads, okay, and which you would probably want to avoid. This warrant here, is it on tight spreads? No, because the bid and offer spread in this case is not 0.1 of a cent, but 0.4 of a cent. And what we have done as an issue here is that we've widened the offer price of the warrant. Okay, we've kept the bid price, as it is at a correct fair bid price, but we've made the offer price higher to make it more expensive. Now, why have we done that? Some people think, oh, because as a warrant issuer, as a market maker, you want to make money off of wider spreads. But the answer is no, and I will share why. Because first of all, as a seller of a product, any product, even if it's orange or anything for that matter, it is in the interest of a seller to sell you things, right? And so in order to sell, they will want to keep the price as competitive as possible, and this means being on tight spreads. However, sometimes we raise the offer price to make it expensive for you, and as a way of indicating to you, because during live markets I'm not able to communicate to you as I am now by a seminar, okay, I have to find a way to communicate to warrant investors our reluctance to sell this product. Why are we reluctant? Probably because it's very short dated. This warrant here, you see, it expires in 2 weeks time, okay? So it's probably very risky for the investor, and therefore we're making it expensive so that you avoid this warrant and choose other warrants over Alibaba instead if you're interested in Alibaba, okay? But otherwise, most times we'll keep it on tight spreads, and we want it on tight spreads because we want you to have a pleasant trading experience in the warrant. We want you to be able to, sell back at a lower spread, right? At a fairer spread, at the tighter spread, rather than this. In this case, if you have bought it on the wide spreads, you need the warrant to move a lot more in order for you to break even. In this case, you see, you need the warrant to move $4 higher you need the underlying price to move $4 higher in order for you to scratch or break even on this trade. So it's obviously not a great value proposition. And as an issuer, contrary to some misconception that some investors think that as a market maker or as an issuer, we want investors to lose money. The answer is no, we actually want you to make money. Why? Because we want you to have the good experience to come back for more. And obviously, the more you trade, the better it is from our product standpoint. And then if you, at the same time, we are also hedging our position. So when you do buy a warrant, and say if you lost money there, we actually don't make the amount of money that you've lost. Some people think, oh, I've lost 10,000 from this trade. Macquarie must have made 10,000. The answer is no, because we hedge the exposure. When you buy a call warrant, we actually go into the stock market or the futures market to buy the shares of futures. And if you bought a put warrant, we go in to sell. And so if you have cut loss on these positions, we also cut loss on them. And how do we make money then? I think the simple answer is that we make money via holding costs. Again, as with a lot of, I think, product issuers, listed leverage product issuers in particular, which all have holding costs in their product. They might not be called time decay, they could be called something else, but essentially that's how they make money, whereby the longer you hold on to the product, the more they make. But, in our case, we also want to ensure that you make, right? So the examples I've shown and all the tools we've developed are so that you know your maximum holding period, so that you can continue making money even if you're holding onto the warrant, whereby the gearing offsets the time decay. In this case, it could then be a win-win situation whereby you are making money and so am I. Okay, but let's come back to the point of holding costs. Warrants are meant as a short-term trading instrument, and so when you hold on to it, of course the time decay is going to erode, right? So we want to make sure that you know what the maximum holding period is so that it doesn't completely erode your gains. Okay, and with that, I've come to a conclusion of the 4 steps of selecting a warrant. Okay, I repeat, always have a target entry and exit level and underlying, and use the selector tool to choose amongst the various warrants that are out there in the market, okay, and narrow down to the 1 or 2 warrants that you're deciding. Okay, know your holding period via either the selector tool or the calculator tool. And 3, know your gearing levels, know the kind of risk you are getting or experiencing with the warrant that you've chosen, okay, whether it's a high one or the low one. And then in turn, use that to decide what your exposure or your warrant investment amount is, okay? You do not invest the same amount of money that you do in the shares when you are purchasing a warrant. Why? Because they magnify your gains, right? Therefore, if you were to invest, 100,000 in a put warrant to hedge $100,000 worth of shares that you have, you're effectively magnifying your exposure. You're not, you're not hedging, the portfolio of shares, right? You're in fact more than hedging your portfolio of shares because of the warrant's ability to magnify the stock moves. Okay, and then finally, always choose a warrant on tight spreads. I do have a interesting anecdote of someone insisting on buying a warrant on wide spreads, and the reason is because they think if the issuer, widens their spread, it must be because it's a very good warrant and we don't want you to buy. Okay, so no such thing. Okay, please do not have the misconception. If we wanted to sell you a warrant, of course, if you wanted to, to ensure that it's the most cost effective, always pick a warrant on tight spreads. Okay, and the live matrix tool will tell you live whether the warrant was on tight spreads or not. Okay, and with that, I've come to almost the end of this presentation. Now, gearing works, beautifully if your view is right, but know that it can work against you when your view is wrong. So it works both ways. And like I've said, the warrant tool is one that is, that has got expiry date, it's got limited life. So always ascertain your holding period. Warrants also are meant to be traded like shares, meaning you can enter and exit anytime based on your target entry and exit level underlying. So you don't have to hold it onto expiry. You exit, when the underlying has hit your exit levels, right? Some people have the mistaken perception that they have, once they buy a warrant, they have to hold it to expiry. In fact, generally we would say no. Why? Because as you will know by now, time decay will set in if it went, you would hold it all the way to expiry. Okay, and finally, if we're talking about some of the foreign indices of Hang Seng, the US indices, Nikkei, note that small changes in the FX during the day could lead to small changes in the live matrix or the price of the warrant during the day. So use the live matrix to know that. And finally, as with all products, there's a chance of losing the entire capital amount, but hopefully the fact that the warrant price is low and your warrant capital is low, rather I would say the investment capital that you put into warrant is low. Hopefully that limits your losses, even if you were to lose the maximum amount, typically during expiry if the warrant finishes out the money. Okay, and with that, I've come to the end of the session. Okay, if you would like to check out some of the videos that we have collaborated with key opinion leaders on to present their view on the underlyings, as well as how you can use warrant tools to select a warrant based on their view, please scan the QR codes that you see. Follow us on our Telegram channel or on our Facebook channels to also be informed about warrant sessions that we partner up with brokerages like Phillip Nova to educate investors on. And yes, I've come to the end of it. Please send through your questions in order to win the $10 Grab voucher, and we'll be happy to take it. Send them in. We do have one warrant, and the asker is, what's his name? We're seeing Tangam here. Thanks for this question, but your question is, how much is the minimum brokerage for buying a warrant? I think that's actually more a question for Phillip Nova. So will you be able to take it?
Oh yes, I think have some minimum brokerage fee that you can search online, because you can go to phillipnova.com.sg and then under structured warrants to see our fees and charges. And then also the questions will also be delegated to a sales representative to answer and follow up tomorrow.
Okay, there's another question. We don't see the name of the asker here. So we do need your name, because that's how you can get the Grab voucher if your question was one of the top questions. Must I sell my warrant to make money? Can I wait for expiry and get the shares, for instance, on the call warrant? Now, that's a really good question, but hopefully I have partially addressed that already, whereby, in my concluding remarks, I've said, you can sell your warrant anytime to realize your gain, just like how you would sell your shares anytime to realize the gain. But if you wanted to hold it to expiry, okay, then you run the risk of obviously the time decay setting into the fullest, because time value becomes zero at expiry, okay, and you could get nothing back at expiry if the warrant finishes without a value. But for some people who think then it's fine, I would take delivery of the physical shares or futures. Now, all structured warrants listed on the SGX are cash settled. Okay, so yes, they're European style and they're exercise at expiry, but you do not take actual delivery of the shares, because when you do so, it actually no longer limits your loss. Your loss is unlimited, right, for as long as the shares go down. But remember, I said warrants are limited. Warrants are limited in the loss in that the most you can lose is whatever you placed up front. So that means if at expiry, the warrant expires with no value, you do not have to take delivery of anything. You just lose your capital that you placed up front, and you don't have to do anything once you have paid up for the warrant at the point where you bought it. Okay, for those whose warrants expire with value, you also don't have to do anything, because this is a cash settlement, and we will send you a settlement amount to your CDB address that's registered under your account. Okay, so I hope we have answered your question, but that is a good question and a very common misunderstanding. You have to hold on to your warrant to expire to realize your losses. Not true. Okay, there's one question from Jaren. Given the similar nature of warrants and options, from an investor's perspective, what are the benefits of a warrant other than the gearing? Very good question as well, Jaren. Most people ask what the difference is between warrants and options. Well, I think first of all, the options are traded over the counter, whereas structured warrants are listed on exchange, right? So first of all, the ease of getting in and out with the presence of a market maker on an exchange, on a listed exchange, right, is going to be more than the option listed over the counter, whereby there is no market maker, and so your ability to and your ease of entering and exiting the position really depends on whether there was a buyer or seller. Say you bought an option and you wanted to sell it, you can only sell it if there was a buyer. Whereas with the warrant, you had bought it, you wanted to exit when your target level has been reached. There is the market maker providing the bid and offer prices for you to easily enter and exit. So I think that's one, the ease of entry and exit. Predominantly, and obviously, if you wanted to, have a product where you could, trade not on margin, where it's cash settled. This is like an option, right, where you get to trade on margin, on a margin account. Then there is also that difference, right, where it's cash settled and it could either be traded on contract or not, and you could, then just not get a ring if your margin requirements, were not fulfilled, right? So that is another example. And I would say, look, there are other smaller differeces between the warrants and options, but predominantly in terms of benefits, I think that will be it. Sorry, maybe I should also add, with options, obviously you get to issue the option, right? You get to sell the option. Whereas for warrants, the market maker is the one holding onto inventory. We issued the warrants. So if you wanted to earn from time decay, you couldn't. Whereas with options, obviously you can earn, the what they call theta. You can earn that when you actually put up an option to sell and someone buys it. For warrants, you can't just go make a short on the warrant. You have to cover it intraday. Otherwise, you'll be subject to the buy-in rule of the SGX. Okay, so you are not able to issue a warrant. Okay, now we've got another question by Kay. What is the advantage of warrants over DLCs? Now, with DLCs, this presentation has not, covered the basics of DLCs and how they work. And obviously, I'm not an expert on it because I'm more the expert on warrants, if I may say. But just very quickly, rather than advantage, I would maybe say what is the chief difference. I think if you look at DLCs, they generally have got fixed levels of leverage, right? Of 3 times, 5 times, and 7 times. Whereas with warrants, you really have a full range, anything from 2 times to 20, 30 times. So, if you were very certain of your view in the short term, whether you're very bullish or very bearish, of course, if you're bullish, you buy a call, if you're bearish, you buy a put. But if you were very certain, I think maybe for some people, 7 times is not enough, right? And so you often find some of our most popular warrants, generally over the Hang Sengs, they do have gearing levels of more than 10 times. And that's really a show of how short-term traders have such a bullish view, whether intraday or in the very short term, and they want more gearing, and that's something that warrants can provide as opposed to the DLCs. I think the other key difference is DLCs have got an airbag mechanism. which gets triggered once the underlying hits a certain level. So for example, if let's take an example of a share that crashes 20% during the day. So what happens is with the, or it moves 25% or lower, finishes 25% or lower for the day. I think often the airbag mechanism for DLCs gets triggered, and then it gets delisted, right, with zero value if it was a long DLC, or in this case, I mean, similar to a call warrant. In that case, then even if the stock were to rebound the next day, you know, and go up, rebound 10% or 15%, you no longer have the ability to recover your losses via DLC, whereas for warrants, you stand a chance of potentially recovering the loss because there is no airbag mechanism, right? And that is one difference. And finally, of course, the airbag mechanism could also cap a DLC's upside, apart from the gearing cap. Whereas for warrants, you know, again, if the stock were to go up 30% during the day, and that has happened before to some of the Hong Kong stocks, then the warrant continues to magnify and really, I mean, in this case, it's going to keep going up the more the underlying moves in your favor. So the gearing of this warrant could be 7 times when you first entered the position, but if the stock moved up by 30%, you'll probably find that the warrant will move 7 times, more than 7 times, right? In this case, it would probably move 10 times more, because how gearing works is that the more the underlying moves in your favor, the more gearing it enjoys, as you have seen from the examples that I've given via the Nikkei, where, you know, the warrant has moved more if the underlying were to go up 10% relative to if the underlying were to go up 3%. Okay, do we have more questions? No? I think is this a last minute question? Okay, there is one by TY. Can I confirm if the target strike price is hit before expiry, the warrant would still not be knocked out? Oh, another very good question. Now look, we haven't covered the strike price in detail during this warrant session, and some of you are wondering why is that, especially those who are familiar with options, right? And the reason is because with the tools that we have, you know, introduced to you, whether it's the selector or the calculator tool for you to select a warrant, all these have been factored in, you know, the strike price relative to the underlying, thereby affecting the delta and the gearing and all that. So, I mean, given that this is a basic warrant session, perhaps we could do an advanced one where we talk in greater detail of some of these parameters, features of a warrant that you could be interested in. But essentially, when you trade a warrant, how it moves relative to underlying, yes, it takes into account strike price, right? But you actually do not have to concern yourself with the strike price once you have selected the warrant, right? Because you're effectively looking at the price of the warrant, the spreads, the gearing, and your maximum holding period, as I've talked about, and more importantly, your underlying target levels, right? So you don't need to consider the strike price because you're not actually taking delivery of it. So if you're asking TY, you know, what if the Hang Seng I bought a 19, well, it's not quite 19,400 now. What if I bought a 17,400 strike call warrant, and if the futures move to 17,400 from where it is now 17,000, does that mean it is only then that I make money? The answer is no, right? Because the warrant will continue to track the underlying, even if it was an 18,000 strike. It will continue to move higher, even if the futures did not go to the strike level, okay? If that makes sense. You do not need the warrant to move to the strike level in order to make money. The strike only matters at the expiry date, where we are trying to determine if the warrant finishes with value or not, right? Generally, a call warrant finishes with value if, you know, the spot price were to be higher than the strike, for example. So again, going back to the question, the strike does not matter in whether you make money or not, okay? Generally, the call warrant should track the underlying higher, and how much they move, to what degree, how much gearing, depends in a way on strike, but you don't have to concern yourself with that because the gearing already reflects that. Okay, finally, so which question is this? No, I think we've got another question. I think everyone's getting quite competitive with the $10 Grab voucher, it seems. Did Jim ask a question? So someone asked, Hang Seng warrant for intraday trade, risk of holding them, right? Okay, I think to paraphrase the question, so a Hang Seng warrant is mainly for is the Hang Seng warrant mainly for intraday trade? and there is more risk of holding them. Now, I think it could apply not just to Hang Seng, but generally to any underlying. Some people say, look, if you've got holding costs, then I'm better off, just trading intraday. I enter and exit during the day, I don't have to pay holding costs, right? Which is great. Now, yes, that is true, and that's why you do see a lot of day traders and warrants, but sometimes the underlying doesn't move to where you think it's going to go during the day, right? And therefore, you probably have to hold to it in order to make your the magnified returns, right? If you were to hold it during the day, you probably sometimes even have to cut loss. But sometimes if you hold it to the next day or a week later, that's when you could realize your magnified returns, your geared returns. So the answer to your question is no. Look, there is risk of holding on because there's time decay, but there's also the risk of trading intraday if you got your view wrong. Generally, there's risk as long as you get your view wrong. But I think as long as you were able to make geared returns that cover the time decay or risk of holding them or paying up for the holding costs, it would still be a great value proposition, whether it's intraday or holding it beyond a day or a week or a month. Okay, thanks, Jin, for your kind words. That probably will not get you a $10 voucher, however, but thank you. Hope you guys had a good session. Maybe following this session, we could look to arrange an advanced session, but otherwise do join us on Telegram so that we can offer you further content. Thank you very much. Have a good night, and hopefully you make money in the markets via warrants. Thank you. Bye-bye.
Thank you, everyone. Just to stay tuned for a while, that Jim is going to select the 3 questions shortly, and then we were going to notify you tomorrow for the 3 questions that Jim is going to pick. Then also just wanted to remind everyone that it's Phillip Nova's 40th anniversary, so there are some upcoming promotions that is good for you. First is if you are not a Phillip Nova client yet, open and fund your account, then you can get the 250 decathlons voucher. And then it is October only, so you can act now and then scan the QR code for the more information. And then also, this is the anniversary giveaway that for the existing clients, if you are the clients with Phillip Nova already, it's time for you to stand to win the Apple Watch Ultra and more. And then what you can do is to trade futures from now till 30th of November, and also to maximize your chances of winning to trade in Phillip Nova 2.0 or trade in the QD Signal Center on the MT5. So this is the giveaway that you can participate if you are the client. Okay, so for the Q&A section for the $10 Grab voucher, Jamie is going to select the 3 questions, and then we will notify you through the SMS or the email.
Okay, I think one of my favorite questions was from Jaren. Of course, I like them all, but Jaren, you asked about the from an investor's perspective, what are the most important differences between a warrant and an option? And then another one that was, I think, pretty good is, what is the advantage of a warrant over the DLC? I like how you phrase that. That would be quick ping. Okay, and finally, drum rolls, the third one will be from WHC. The question was, must I sell my warrant to make money? Can I wait for expiry and get the shares, for instance, on the call warrant?
Congratulations to the 3 winners of the Grab vouchers, and also thanks for Jamie's all the insight for sharing. And then I think definitely our attendees and audiences will know how to get started on trading the warrants. And then also just to also look forward to seeing you of the upcoming webinar as well. Thank you, everyone, and
Bye. Good night.
Bye.